If you buy a stock without any research, simply hoping the price goes up tomorrow, are you actually investing or just gambling? Making a financial decision based entirely on a line moving upward on a chart removes all control from your hands. You aren't examining a company, you're just reacting to price momentum. Peter Lynch tackles this exact problem in Chapter 3 of One Up on Wall Street. He makes a clear distinction. Taking a risk and blindly gambling are two entirely different things. In a casino, you place a bet on a completely uncertain, isolated event. Once the dice leave your hand, the outcome is out of your control. There is no underlying value being created. Investing operates on a different mechanical reality. When you buy a publicly traded share, you are acquiring a fractional ownership stake in a living, breathing business. That entity sells actual products, pays expenses, and generates real revenue. Stock exchanges exist to facilitate business ownership, but the decision to focus only on price movement and ignore the company underneath is what creates the gambling behavior. The most common error beginners make is tying their emotional state to the daily ticker. They equate a rising stock price with a brilliant decision and a falling price with failure. Imagine you research a strong, profitable company and buy its stock. Suddenly, broad market panic sets in across the trading floor, and the share price drops 20%. There are two possible reasons for this drop. The first is that the business itself deteriorated. Customers are leaving, debt is rising, and management is making poor decisions. In this case, the original reason you bought the stock no longer exists. The second possibility is that the company remains highly productive, sales are still climbing, and profit margins are stable. The business is perfectly healthy, but irrational market sentiment dragged the share price down anyway. To understand why this distinction matters, we have to look at the structural difference between debt and equity. It clarifies what ownership actually means. As this balance shows, buying a company's debt, like a bond, makes you a lender. You get a capped, guaranteed return with lower risk, but buying equity makes you an owner. You embrace short-term uncertainty in exchange for the unlimited, long-term upside of the company's growth. An intelligent investor separates the daily, erratic fluctuations of the stock price from the long-term productive value of the business they actually own. Even when you understand ownership, it is incredibly easy to fall back into behavioral traps. The first is social proof, often disguised as the hot tip. Buying a stock because a friend assures you it will double next year means you are transferring your financial decisions to someone else's unverified opinion. You are completely ignoring the actual business. The second trap is emotional holding, the sunk cost fallacy. This is the dangerous psychology of watching a stock drop 30% and refusing to sell because you feel it has to bounce back. Lynch offers a cognitive reset for this exact moment. He suggests asking a simple question. If I didn't own this stock today, would I buy it at its current price? If the honest answer is no, it's time to reevaluate. Relying on blind faith or stubbornness strips away your analytical edge, converting a reasoned investment back into a blind gamble. We have to acknowledge a hard truth. Risk is permanent. Even the largest companies can fail. New competition emerges, and entire industries face technological disruption. Because absolute certainty does not exist in the market, the true goal of investing is to use diligent research to shift the probabilities of success into your favor. Think of Peter Lynch's checklist as a mechanical filter for your portfolio. It catches and eliminates blind bets based on hype, only allowing verified information to pass through. The process starts with a basic interrogation. Can you explain in simple terms what this company does? Do you know exactly how they make their money? And is there a logical reason their sales will grow in the coming years? The final phase examines the balance sheet. You must determine if the business is financially healthy enough, with manageable debt and strong cash flow, to justify holding on to it even if the broader market crashes. This research cannot eliminate the possibility of loss, but it anchors your decisions in a business thesis, preventing you from making a blind, uneducated bet. Lynch leaves us with one ultimate mental model to test our conviction. It's the 5-year closed exchange test. Ask yourself, if the stock market suddenly closed tomorrow morning and you were completely unable to sell your shares for the next 5 years, would you still be happy holding on to this business? If the answer is yes, you are acting as a true business owner. If the answer is no, You are just playing the casino. So once we understand the necessity of finding real, productive businesses, the next question becomes practical. How do everyday people spot companies with 10 times growth potential before the professionals on Wall Street even notice them? We will explore exactly how to find those opportunities in Chapter 4. It's only a 10-bagger. Make sure to subscribe so you don't miss it.